quick update. So the first chart we'll begin with is the chart of Nifty. There is too much of noise that the market trend is relatively weak and there are odds that the market will correct and the returns will be muted. I personally disagree with this. I disagree with this because too many people are caught up in analyzing headline indices in the market. That is Nifty 50, Nifty 100, 200. This market that we are currently into is not a market where headline index is truly reflecting what is going on. Yes, just about 50% stocks in the market are in a very good structure. Remaining are still struggling. But this is a market where even if broader market indices like Nifty 50, 500 remain stable, we are going to see relative outperformance in portfolios. And this is what the video is all about. I'll first begin with Nifty. Now we are hovering very close to the 50 DMA. This is a 50 DMA chart. This is a ratio line with respect to Nifty 500, which means price of Nifty divided by Nifty 500. We are right at 50 DMA. We do have a gap here. Friday was a very good day for the US and global markets, so maybe we have a minor gap up on Monday morning. That is something I don't know. But overall, I don't think there is anything wrong in the market. It is all about how you look at the structures today in stocks and sectors that are still setting up beautifully in the market. In the last 15 odd days, we've also had a couple of events that have worked in favor of the market. Now, primarily, that is S&P 500 upgrading us. That is almost after 15, 17 years. That is a super positive news. That is something I wrote about also on Twitter. Then you take into consideration that the GST announcement with respect to reform that happened, that has primarily led autos and consumption sector to do very well in the very short term. I'll explain that in a bit also. So cumulatively, there are things that are getting in favor of the market. Plus the RBI is super bullish on the economy. Their stance on interest rates is pro-business. So these all things won't allow the market to fall a lot. And this is what you have to understand. So my broader hypothesis, I'll just repeat once again, I'm not expecting anything major from index in the remaining of year also. I think we'll only have a sustainable trend in index in 2026. Now coming down to, there are few stocks here. I have to give a disclaimer. This is not an investment advice or a trading advice. These are all stocks that are within the Nifty 500 index. Nifty 500 basket, that is. So obviously this cannot be an advice. But I want you to focus on stocks and more importantly, structures that are setting up well in Nifty 500. Because even in Nifty 500, there are only 51% stocks that are above 200 DMA. 49% are still below it. So the way I have sorted out these stocks, in my opinion, all the stocks that come first are the stocks that are in strong stage 2 structure. What is strong stage 2 structure? A clear higher high, higher low, and a rising relative strength. That is stocks that are outperforming the market. And within this, there is a subtle message that you have to understand. So now I'll flip through some charts so that you can understand which structures I'm referring to. And that is something you can replicate in your own watch list. The name of the stocks will obviously come here. If you want to look at the industry, because that is what I want to focus in this particular video, you'll have to read here. For example, this particular stock belongs to the finance industry. The next stock belongs to the aerospace and defense industry. The next stock is industrial manufacturing, electrical equipment, finance, auto components, industrial products. Keep looking here because this is where you need to pay attention. Transport services, aerospace defense, capital market, chemicals, food products. This is a cigarette and tobacco company. Pharmaceuticals, auto components, again auto components, insurance, financial technology, capital market, finance, just one IT service, auto components, aerospace defense, healthcare services, pharmaceuticals, capital market, automobile. The thing I'm trying to tell you is that there are only handful of pockets that are currently working in the market. And those pockets we have repeatedly discussed. It is defense, it is capital market, it is insurance, it is asset management, it is chemical and fertilizers, then comes even NBFCs. So these are the pockets, hotels also, these are the hospitals, these are the pockets that are consistently doing well in the market. And if you look at all these names, bearing a few will be in a structure where a clear higher low is visible and relative strength is rising. Now, there are some charts like this also that have come down below 50 DMA. You have to keep in mind that these were the stocks that had a major run up in the month of March and June. So this correction has to be seen in light with what happened here. Then you again look at hotel services. Then you look at, there are a couple of names from cement sector also. But if you go to the bottom list here, that is the names that are right at the bottom, and you look at the structures here, now start looking. You'll find a similar pattern. That pattern is a clear structure of lower high, lower low, with a structure where even relative strength line is clearly heading lower. So this tells you that these are the stocks that have to be clearly avoided because market is telling you that these are the stocks that are underperforming the market massively. This is an exception. This should be on the upside, but sometimes mistake happen from my side also. But broadly, I hope you get the message. All these stocks are stocks where relative strength is clearly trending lower, and it is so easy to eliminate so many names where things are not working out with respect to the structure, and certainly not with respect to the outperformance that you need stocks to exhibit. So if you go through this entire list, obviously I cannot cover it, but if you go through this entire list, even from a list of Nifty 500, you will find about 200 names that have clean structures in terms of prior trend and then consolidation. There are some names that are just going up because the relative strength in these names are improving a lot. But again, they belong to a sector where there is a lot of momentum and there is a lot of buying pressure. This is going to be the theme. This is going to be the theme because ultimately in markets, it is the group movement, it is the sector movement that dictates a lot of things. Now, post this GST announcement, you've also started seeing auto component companies also coming back to the picture, and it will play out for a while, mainly because GST, if they don't manage to mess it up, that is a big if. That is why currently I'm not going behind auto stocks a lot. I want that news out of the way. I want to read the finer details, because sometimes what happens, you have certain direction where you want to take the reforms towards, but at the end of the day, when it comes to implementation, that implementation does not play out in favor of market, or it does not simplify the already complex things that are there in GST. For anyone of you who has dealt with this, you would have known GST currently is so complicated, it is complex, it needs to be simplified. I hope they don't come out again with 4 or 5 slabs. Some of the things are moved here and there. I think they need to make GST simple. If they can do it, that would be a massive fillip for the stock market. And I think market would start pricing that in a lot sooner also. So if you take a look at all these sectors that are coming up in the top 50, top 100 names, you will find repeatedly auto components are there, fertilizers are there, finance is there, capital market, healthcare, mainly hospitals, again, agriculture, a couple of cement names are there, pharmaceutical, healthcare. So these are the sectors that have been driving the market higher. And this theme won't go away so soon. Whereas in the bottom top 100, you'll find there are mostly IT names, then certain pockets of pharmaceutical healthcare that is not doing well, some agricultural names. You will also find a lot of names that are from the metal space, which I think is a dark horse. Metals will catch up. Again, a lot of software, realty, oil and gas. So there is a clear divide in the market. Even if you look here, consumer durables, so consumable fuels. So consumption entirely is not a basket that is going to make a comeback so soon. The budget cut that happened in the union budget, that is 12 lakh rupees of income tax rebate that was given to the people, largely I think that has gone into savings still. It is the GST reform that is going to bring back a lot of fillip in the market in terms of demand. Earnings will improve, and I think that is what was required at this particular stage. Now, one more point I want to highlight that is clearly understandable through ETF market is that the global world currently is relatively stable. And this is reflected in how the ETF data is shaping out. If you look at which ETFs are currently doing within our markets also, and again, I've just arranged this based on how I feel the trending structure looks. We all can see it differently. If you look at Hang Seng Bees, this is a beautiful contraction, clear, higher, high, higher, low. Look at the relative strength. You look at Silver Bees, again, coming back very close to 50 DMA. You look at the NASDAQ index. This is the big 7 stocks in NASDAQ index. Again, a clear trending structure. You look at the Hong Kong tech sector. Again, a beautiful contraction is playing out right at 50 DMA. Of course, my preference always is to look within our market, because I personally feel that there is no opportunity in the world that is going to match the opportunity that is there today in India. And it is going to remain this way for the next 20, 30 years at least. So if you don't understand stocks, if you don't understand how to pick good quality companies, stick to ETF market. There are some wonderful opportunities here also. You look at the Motilal Oswal Defense ETF. It has now retraced back from 100, to something like 80, 82. This is nothing but a new base getting formed. Don't be short-sighted. There are some tremendous things happening in India. You have to be part of this story. You look at the capital market index. A beautiful base is again getting formed at 50 DMA. You look at gold bees, again, a beautiful structure right at 50 DMA. The difference between gold and some of the indices that I'm sharing here is that trades like gold and silver largely are a consensus kind of trade. And we need a correction in this for better risk reward opportunities. But otherwise, you look at the financial sector here, again, come back to the 50 DMA. It's forming a nice base. These are all medium term structures. Consumption has suddenly popped up. It was forming a base. This is a beautiful breakout. You look at auto is also, it was forming a base. Now this is a clear breakout that happened at 256. Now it is just stalling. Let the news play out. If you get a correction, get a pullback, look into these strong spaces. PSU Bank, I feel, again, is a dark horse within the banking sector. It's again forming a beautiful contraction right at 50 DMA. Then you look at mid cap 150, again trying to form a base at 50 DMA. Things that are not doing well are IT sector, infra sector, again realty sector. But these are all SIP opportunities. Try and understand. The first 10 odd names are opportunities where you can go in over the medium term also. The bottom 5 6 names are names where there is opportunity from long term. Do you think this is the end of IT sector? No, it is not. IT sector has actually done nothing. If you take today's 20th August 2025, 23rd August, on 17 Jan 2022, it was at the same level, this ETF. So about 3 years where there is no return, because post COVID there was massive return in this sector. The ETF went from 14 to a peak of like 40. That is about 270% on an index ETF. So IT is doing nothing currently, but for those who are looking for the next 6 7 years in terms of investment, IT sector is at a beautiful level. Again, it's your money, you have to do your own research. If you like some of these sectors, let's say you like something like a defense sector, you like something like a capital market sector, then you have to go back to the structures I have covered here. And those structures are clear trending structure, higher high, higher low, clear strong trending relative strength. These are the stocks that you can enter anytime during a pullback, or if you're a slow gradual accumulator in the market, you can just jump in these stocks, in these structures. Let me not say stocks because then it becomes an advice, but such structures where there is clear higher high, higher low structure, and the pockets that have corrected a bit have gone out of favor in terms of traders, investors. Off late, there is a lot of buzz around auto consumption. Look at which pockets were doing exceptionally well 3 months down the line that are not coming up that much on social media radar or media radar. For me, something like a capital market, defense, it perfectly fits this bill, because I was someone who participated in defense here. I was someone who participated in capital market here. So naturally, I have positions here. This is a second base that is getting formed where I would like to add to my winners. Of course, I would look at autos also, consumption also, but not when there's so much of buzz around it. If I want to take exposure, probably I'll just take 20% of what I intend to. Let's say I want to buy 20 shares, I'll buy 100 shares, I'll just buy 20 and today sit. And then I'll wait for the GST news to come by, the sector to react. If it runs away, that is fine. It was not in my luck. But otherwise, I don't like chasing when the news flow is so hot with respect to a particular sector or a particular pocket. So banking sector also, if you see, banks won't do that well as something like capital market or insurance or some housing finance pockets or pure finance play. Also, banks will be relatively underperformers to pure financial plays, but eventually banks are also going to do very well. And metal, of course, is a dark horse. I feel metal is forming a beautiful contraction from long term, from medium term also. And today the metal ETF is at what, 9.4, 9.5. Take it around about 9. I don't think that this metal sector ETF is going to be here 15, 24 months down the line. Again, it is a perspective of time, that is from the medium to long term. Not many people have that capacity to hold things. That is actually a problem in a stock market. See, the way I'm looking at this market is that this market is again in a zone where you have to accumulate. And this is something that I'll just explain with this particular chart. So this chart that you see, the reading that you're seeing 19.35 or 18, this can certainly go down to 12, 13. I'll just explain in a bit. Now, this is where the market was back in 20 to 23 during COVID also. It's an extreme reading way back in 2017. These are phases that are phases where market struggles a lot, but it is a market where you accumulate so that when the next big swing plays out, you stand to benefit. One of the key mistakes that I've always spoken about, look at this level here. This is 91, somewhere here. This is where participants come because there is so much of euphoria in the market. Again, these phases that you're seeing, this is where majority of participants come in the market. They don't participate in these phases where majority of stocks are just not in the right kind of structure. And that is where we are today. Majority of stocks are just not in the right kind of structure from the medium to long term. They are improving their structure. Whenever in the market things are improving, that is the time when you start looking at setups. That is the time when you start holding on to whatever you bought in this initial phase in the market. So don't have a short-term mentality in this market. Look into the spaces that you understand, that you like. the list of strong sectors I've given out many a times, and that is my preference. Yes, I'm beginning to track autos and consumption also, but I let the GST reform news come before I take any big bet in these sectors. I have a mentality of holding in this particular market. I still have about 35-36% cash that I'm looking to deploy, so I'm in no hurry. But I remain super bullish in this market. Yes, the data is not entirely great. We are struggling in terms of momentum. There is absolutely nothing that is moving up a lot. Handful of stocks, about 45-50% stocks are above 200 DMA. And even 50% of those are not in a strong momentum kind of structure. So it is a difficult phase, but it is a phase where you accumulate so that whenever the next momentum phase comes in the market, you're already ready. So have a great weekend ahead. Take care and be safe.